If you've driven anywhere in the Philippines over the last month, you've felt the squeeze. Relentless fuel price hikes have been suffocating daily commutes and slowly choking the life out of operational budgets. That localized pain at the pump quickly rippled outward into national macroeconomic fears. High inflation warnings flared up, and the Civil Aeronautics Board pushed passenger fuel surcharges to a punitive level 15, adding thousands of pesos to travel costs. Week after week, this persistent price squeeze has systematically drained the average Filipino wallet, threatening basic household survival and narrowing corporate business margins. But on June 2nd, the market delivered a massive, sudden shock to the system. Drivers woke up to one of the largest single-week fuel price rollbacks of the entire year. The raw numbers were staggering. Diesel plummeted by up to 7 pesos and 50 centavos per liter, while gasoline prices dropped by up to 4 pesos and 50 centavos. Almost immediately, the secondary relief followed. The Civil Aeronautics Board drastically slashed those punishing flight passenger surcharges down to level 13, which raises the real question: why did global oil prices crash so violently overnight? And more importantly, how can local investors exploit this sudden vacuum for profit? To understand the sudden drop, we have to look to the Middle East, specifically at the recent military tension choking the Strait of Hormuz. This chart shows exactly how fear dictates the market. You can see global oil prices steadily climbing here, but this red gap at the top is what analysts call a geopolitical risk premium. It's an artificial price spike. The fear of 10 million barrels being blocked from transit pushed crude past the $100 threshold. Then came the pivot. Negotiators from the United States and Iran sat down in Doha and hammered out an outline for a 60-day ceasefire. The moment those reports surfaced, the market reacted instantly. The prospect of a peace deal erased that risk premium entirely, sending crude tumbling sharply back down into the $90 range. Global commodity prices are driven just as much by the anticipation of conflict as by the actual physical logistics of supply and demand. Now, let's bring those savings back to the Philippines. When a developing, import-dependent nation gets access to significantly cheaper oil, it sets off a very specific chain reaction. The first domino to fall is local delivery. As massive shipments of cheaper fuel arrive, nationwide supply chain and logistics costs experience an immediate drop. This flowchart tracks where those savings go. A drop in the cost of a barrel directly translates to cheaper delivery trucks. Cheap freight is one of the strongest forces capable of pulling down national inflation. With that inflationary pressure easing, the central bank is given breathing room. Instead of being forced into panic hiking interest rates to control prices, they can hit pause and let the economy stabilize. This chain reaction, flowing from a Middle Eastern ceasefire to Philippine inflation relief, creates a massive hidden window of economic growth for those paying close attention. This rollback functions as a direct catalyst for corporate profit expansion across the Philippine Stock Exchange. The first sector poised to win is aviation. Global jet fuel dropping from $179 down to $159 per barrel alters the basic cost structure of every flight. It creates a powerful multiplier effect. Cheaper fuel combined with lowered passenger surcharges results in cheaper ticket prices. That drives higher travel volume and generates much wider profit margins for the carriers. Next up is the logistics and supply chain sector. For freight and delivery companies operating massive fleets, a 7 peso and 50 centavo drop in diesel is pure, unadulterated profit margin expansion. The third winner is consumer goods and retail. When inflation cools off and filling the gas tank hurts a little less, there is a distinct psychological and mathematical shift in how households spend. The extra disposable cash freed up in the average Filipino's wallet inevitably flows directly into discretionary retail spending, driving a noticeable surge in mall foot traffic. Essentially, falling global oil costs act as a mechanism transferring wealth away from global oil producers and injecting it straight into the earnings reports of specific Philippine industries. We've traced the invisible string of the modern global economy. A peace table in Doha crashed crude prices, which eased local inflation and ultimately paved the way for targeted stock market gains. With the trajectory of the market now visible and that extra capital available, where are you deploying your funds? True wealth is built by seeing the global domino effect before the rest of the crowd does. Subscribe to the channel to keep your macro perspective sharp and let us know your top stock picks in the comments below.